Sorry, power just went off my place. You can hear me?
Yes.
Okay. I've even lost my work. I hope you had taken note of it already.
Yes, sir.
I think we are discussing on the payables. We think it was it was payables, if I remember, which the increase was equal to 50%. Okay, so I was trying to explain that even here, what's happening here is not as bad that payables is going to increase, provided it is increasing to support the sale, provided it is increasing in line with the increase, for example, in the receivable. Okay. However, to make it worse here, what is mostly happening is that the company has more reliance on the suppliers. In short, like they take longer to pay the suppliers. If maybe they were taking the same number of days before, okay, then that's going to be a problem. That hey, you have more payables for sure. However, you have enough cash to pay your suppliers. That's why the number of days for payables is the same. But let's see whether the case, because I highly doubt whether the case, okay, that maybe the number of days are increasing. You're taking longer to pay your suppliers. Then that's an indication of a problem. Now let's do it for sure. Let's do it, okay. Now, the number of days, okay, if you see they have the industry, can you see the industry numbers here? Payables is how many days? The day payables days for industry is how much? Only the same question.
50 days.
It's 50 days. Now, the days for industry is 50 days, okay? Now, most likely, the company is taking not 50. Don't forget, 50 is like the optimal. You ought to be at 50. But let's see what it is, okay? Number of days they're taking to pay the suppliers, okay? So let's do for 2015. Okay, you can do it for 2014, but you don't need to do that. Let's do for 2015 number of days. 2015, the payables days for 2015 for this company will be equal to 360 days. 360 days, we multiply by the payable investments. Okay, payable, say payable. This for 2015. How much is this? 1.9 million. Yes, thank you. 1.9 million. We divide by the cost of sales, which is 85.55 million. Hope I have the figures correct. Yes, that should be the case, isn't it? Yes, that should be the case. How many days do you have to guess?
80 days.
Yes, and that drew therefore to a conclusion that hey, the company, you ought to be taking 50 days, okay, to pay your suppliers. And now you're taking 8 days, okay, to pay your suppliers, okay. Then what does it indicate regarding you? You're taking longer to pay your supplier. Why are you taking longer to pay your suppliers? Maybe you don't have enough money to pay them, okay. You have an extra reliance on your shorter suppliers of funds, okay, to an extent that you may not be able to pay even them when it's due. Okay, because generally the other farms are paying them in 50 days. You are taking 8 days. Now, what does this show about you? It means there's something that's struggling. You have a struggle somewhere. Okay, so you can take that note. Okay. Okay. So we can say the company has an excessive reliance on national finance sources. You can use your own words, okay, but the idea needs to remain the same. National finance sources, payables and overdraft, as indicated by their increase of 52% and 192%.
So it's 180.
Further, payables day. Is how much is one?
82%.
Not 182, not 192. Okay, 182. 182%. Okay. Okay, 2 by 1%. Payable days. This is compounded. Just to explain, this is compounded by the increase in payable days. This is compounded by the payable days. There were 8. You got what 8 days? Payable days, 8 days, which are higher than the industry. Which is industry is 5 days. Okay. As I mentioned, okay, it's not about the days can be increasing, okay, but it's bad, okay, in case now that you're even taking longer for your suppliers, then don't get is an indication that something is wrong with regard to your management of short finances. Clear? Question? Okay. So let's do now. That's for the payables. That's for the share finance, the overdraft as well as the payable. But also, the current asset also be increasing. Okay, so next bit is the current asset increase. Okay, the next bit can be we do the analysis on current assets. Current assets increase. So first we can begin by getting the receivable. Okay, the receivable days, the receivable investment, the receivable increase. Let's first the increase. Then you can do the days later on. Receivable increase will be equal to between 2014, the receivable for 2014, 1 million to 2 million. Okay, so 2 million divided by 1 million minus 1 in percent, it does give us 100%. Give us 100% increase. The same for inventory. So it's equal to 2.5 million divided by 2.1 million minus 1, and we express this as a percent to give us how much?
%19.
19%. Okay. So definitely, as the asset, the current asset, we do expect that will be increasing. Okay, but an increase of 100% is quite high. Okay, so let's do even a further analysis that hey, if we observe, okay, the number of days, your days, and what the market is giving, what is happening? Let's do the number of days. Therefore, okay, the next one can be the number of days. Okay, respectively. Okay, days here for receivable. It is for receivable. For the industry, the days is 30. Okay. The company, we expect the company to be taking much longer than what the industry is taking. Okay. The industry in quote the optimal. Okay. Therefore, the number of days, okay, is equal to 360 for receivable times the receivable investment, 2 million. We divide by the sales, we assume that all of them are correct, 17.1 million. You can do it for 2014 if you want, okay? But it doesn't add much value, okay? Because we have the days of 2015, we compare with the industry 2015. But you can also do 2014, but no need to do that. Anyway, how many days you get?
42 days.
You get 42 days, okay? Now compared to the industry, but with the industry, they are 30. You as a company taking 40 days. So you're giving your customer much longer to pay the money. You're trying to entice them, in quote, okay, to buy from you, okay? And as we mentioned, one of the symptoms of a trend is where the company is attempting to achieve too much sales too quickly, but most of the sales are on credits, okay? As you can see here, that the industry, the industry is giving the customer 30 days, you are giving a customer for 2 days to entice the sales. Okay. That's the same for the inventory. Okay. We do expect that the company is taking longer, okay, the turnover, okay, the company is taking longer to be able to convert the inventory into a sale. Even though the company is trying to entice the customer, okay, to pay a bit, the customer to buy on credit, the company is in code like overstocking, okay, serving like excess investment into the inventory, okay, to an extent that they take longer to find a customer. Okay, the turnover, okay, you converted the inventory into a sale is not that guaranteed. It's actually becoming worse off, okay, as time goes by. But let's see the case by getting the number of days. Okay, for the industry is taking how many days? The industry is taking 65 days. Let's see how long it takes the US this company. 36 days. Okay, we multiply by inventory. Inventory is 2.5 million. We divide by the cost sales, which is 8.55 million. How many days is the company taking to, by the time they convert, okay, the inventory into a sale?
105 days.
105.
Yeah.
Well, that's very huge. Okay, as you can see, this has gone even to what we were expecting. That hey, the industry is taking that's 5 days. You are taking 1 or 5 days to convert the inventory. That's an issue regarding maybe that maybe your stock. Okay, you're taking longer to convert your stock into sale. And so you can do the conclusion. The company or the firm's current assets. Let me just present CA. Okay, current asset investment is increasing. It's created at a very high rate. Okay, as shown by inventory, and this will increase. Is 19% and 100% respectively. Most of the farm sales on credit as indicated. Where the higher days for receivable, with the higher receivables days, then the industry. Okay, industry was 30. Sorry, for two days and 30 days respectively. Okay. Okay, the same communication, you can use different words, okay? But you need to be indicating that the company is taking much more longer, okay, to get, okay, to convert its investment to they're making more of sales, okay, towards credit as opposed to be on cash, okay? Here, that's on the case of the receivable, okay? Then inventory. It's clear.
Sorry, sir. Could you repeat the last part, please?
The part for the receivable. I got disconnected myself also on my head, so I don't know which part you mean.
Just the last part.
The one on the screen. Sorry, I don't know what I should be repeating. What should I be repeating? That's last part. I think we lost her. Anyway, what I was trying to mention is that the company is taking longer, okay, in terms of collection from your customer, okay. And as I had mentioned, don't forget, this is how the company, even though the sales are increasing, okay, the company is trying to drive up or to ramp up sales, okay, through selling more credit. Okay, as you're seeing here, there is an increase. The day we compare to the industry, the company is giving their customers 12 more days, okay, compared to what the industry is giving. Okay, so let's do now for the inventory. The inventory, let's do the inventory analysis. Just to make a comment, we've done the analysis, now is comment. Okay, the inventory days, the inventory turnover, okay, is increasing. Okay, as indicated by the increased number of days, as indicated by, it's not decreasing, is worse off, because it's worse off. As indicated by the longer inventory conversion period, inventory conversion period of 105 days, okay, compared to the industry, 5 days, industry 65 days, okay. And this is expected if the company is in a trading situation. Clear? Okay. Now, what's the next symptom? I hope it's clear so far. If you have a question, don't forget, do not hesitate to ask. What was the next symptom? Sorry. Sakina, what's the next symptom?
Let me check.
Sorry?
The next symptom, right?
Mm-hmm. Anyway, since you're done, this next symptom can be more on the regarding liquidity. So you can have here maybe liquidity ratios. We expect that there'll be a decrease in liquidity, but let's do the analysis, then the comment, liquidity ratios. So I think based on what you've been given, so we go as per what the examiner is giving us, okay? So we go as per the industry ratio given there. There are two ratios they are given there, okay? Quick ratio and current ratio. So we can do both of them, okay? Because that's what the industry figure given to you, okay? So let's begin by getting the current ratio. Do not forget if the company, yes.
It's overcapitalization. It's overcapitalization.
What do you mean overcapitalization? The ratio will get
okay.
okay. Overcapitalization now is something different altogether, because that overcapitalization is a case where you have more investment than actually what you need. Okay, that is actually something else I think I'll comment later on. Okay, I'll comment later on. For now, let's first finish up on over trading. Okay, okay. Because over trading actually is also referred to as under capitalization. Okay, so we have another symptom, another outcome of mismanagement is called over capitalization. Okay, but I'll comment later on. Okay, but thank you for bringing it up. Okay. Anyway, so regarding quick ratio, liquid ratio, okay, so we can use two, okay, based on what the examiner has given us here, okay. I hope you can see those figures. Current ratio 1.7, quick ratio 0.8 times, okay. So we can do those two ratio, then you compare with the industry, okay. Now for 2015 for this company, the quick ratio, the current ratio, we expect that if the company is in our trading situation, we expect the ratio to be decreasing, to be becoming worse off, okay. But let's use the case, okay? Current ratio for 2015, where is equal to 4.5 million divided by current liability 4.3 million to give us 1 point.
0.05.
0.05, almost 0.5 times, okay? Now, quick ratio, we remove the inventory, okay? We remain with only receivable. So 2 million, we divide by 4.3 million, and we get 0.
0.47.
0.47 times, okay? Now let's compare that with what should be the optimal in quotes, okay? With that the industry values, okay? For the industry, okay, the current ratio is 1.7 times. What does it tell us about the company? This company have issued regarding the liquidity, okay? Hey, and you ought to be at 1.7, so you have a lower level of liquidity compared to what it should be at 1.7. Okay, let's say that the quick ratio. Quick ratio is for the industry is 0.8 times. For this company, 0.47 times. So it means for this company may be having lower level of liquidity compared to the industry, which was very much expected if the company was over trading. Okay, if we can comment and say. The company or the firm has lower liquidity levels. Then let's compare the industry. Since it has lower current ratio and lower quick ratio. You can measure the figures if you prefer. Okay, lower 1.7 compared to 1.7, a quick ratio 0.47 compared to 0.8 times. Okay, so you can measure even the figures if you prefer, no problem. Clear? Question? Okay. The next symptom we can analyze could be written long-term capital. Okay, that should be the next thing. See, long-term. We try to observe to what extent have the company long-term financials increase or decrease by. Let's see. Let's go there for next working sort of 5. Okay, long-term capital. Okay, long-term capital. Do you have it here? Can we do that analysis? We can't do that analysis because we don't have the long-term finance. Oh, we have debt here. Yeah, we can do that. We have debt here. Okay, so debt. We don't have equity, but we have debt. You have not seen it. Long-term debt, increase is 0%. Because you can see between 2014, 2015, they remain at 3 million each year. So we have a 0% increase in the company long-term debt. An indication that this company might be over trading. Okay. The next working, is it clear, by the way? Question?
Sir, please repeat that.
I will try to observe what has happened to the company long-term financials. Okay. In 2014, the company long-term finance was 3 million. That is debt. In 2015, there was 3 million. There was an increase, 0%. Okay. Don't forget, as we mentioned,
okay.
in overtrading, the companies that tend to achieve too much sales too quickly without enough supporting long-term capital. And this is also this concurs with that what we mentioned. Okay. So the company or the firm has 0% increase in long-term capital. To finance its work, to finance its carbon needs. Okay, so in case we have to extrapolate, okay, we don't need to. Okay, so how does it finance its need? Going back to current liabilities, they finance using more of short-term finance source. Okay, which of course is a result of mismanagement. Okay, anything else you can do which you are not done? Liquid efficiency, you can mention it. Okay. So this is simply the net working capital. Okay, the net working capital. We are expecting it should be having a negative. But let's see, between 2014, in 2014, the net working capital given to us already is 1 million. In 2015, it's 200,000. Okay, so the company, we can't say the company still we can't say the company has liquid efficiency. However, its position is decreasing. Okay, okay, I see that the working capital was 1 million before. Now it has decreased to 200,000. Something good or bad? No, it may be a bad indicator. Okay, that hey, you may maybe next year it'll be a negative. Okay, so far for this year, okay, it is not a negative. Okay, however, we can mention so that its position is decreasing. Okay, the company basically this can make a comment. The company net working capital is not negative. You can mention that it's not negative. However, it is decreasing. It has decreased from 1 million to 200,000 dollars. Yeah.
Sir,
Yes.
suppose it was a negative net working capital, how would we explain that point?
It's again now that's confirms to us. Okay, don't forget this analysis we're doing. We want to draw out of the different symptoms. We draw a conclusion based on those same symptoms. What can we say regarding the company, our trading situation? Okay, now if it was even negative, the better off when it comes to explain the point that hey, if a company is in our trading situation, then generally we do expect it to be having a negative net working capital, and for this company, it confirms. Okay, because there's a negative net working capital. Can I explain that? Okay, but for this example, okay, this particular question, okay, it is not yet negative. However, it might be heading to that particular direction because it is decreased from 1 million to 200,000 within a span of 1 year. Is that clear?
Yes, sir.
Okay, great. Okay. Yes, I think we are done with all the symptoms, I guess so. I guess we don't know symptoms. Now, based on that analysis, we draw a conclusion. Okay, we need to draw a conclusion. Can we say this company is overtrading or not overtrading?
It is over trading.
Yes. Okay. Therefore, say in conclusion, based on the symptoms analysis above, based on the symptoms and analysis above, the firm, we can conclude. I think we can conclude we can conclude that the firm is overtrading. That the firm is overtrading. Okay. Now these are also these are, I think there were 5 marks. Okay, so not are there 5? How many were they? I think there were 5 marks. Was it? I don't know how many marks there were, but in case there were 5, then you don't need to do all that analysis. Okay, I think there were 10 marks, I guess. I'm not so sure. I think there were 10 marks. I think yes, there were 10 marks. Okay, so maybe you may want to do at least one of all those. Okay, a bit of those analysis. Okay, but generally, therefore, don't forget as you can see here, 4 marks are for calculation, and 6 marks for discussion. Okay, so don't ignore the discussion bit of it. Well, that's where most of the marks have been allocated by your examiner.
Sir, so what's the difference between analysis and discussion?
Now, analysis, okay, let me just do the analysis like calculation. Let's use that term, okay? It's like a calculation here. You'll be doing here. Where is it? Let me just go back to the previous slide. Yes, like this one's here with a different ink here. Now, this is the analysis I'm trying to mention. This is an analysis. Then after that, you have discussions. You see this part of the discussion. do the math or calculation, then discuss. Is that clear?
Mm-hmm.
Like, for example,
So this question was both analysis and discussion.
yes. Okay, so it's both analysis and discussion. So this is the analysis bit of it, then this is the discussion bit of it. Clear?
Okay, thank you.
Yes, yes. So don't worry, there's more marks for the discussion as opposed to the calculation. Calculation only 4 marks. Okay, so you have to be quite careful. Okay, don't ignore the discussion bit of it. You don't have to use exact word, but you have to be able to interpret your result. Okay, is it clear?
Yep.
Okay, great. Okay, any other question? Okay, if there's no question, then I guess we can